What's up, people? Welcome back to Invest with T Claus. My name is Tevi, and this channel is dedicated to my investment journey, along with coverage on crypto, Tesla, Neo, Virgin Galactic, and ChargePoint. Come for the information and stay for the perspective. So with all the buzz around Bitcoin breaking past the 70K mark and climbing, it's easy to forget about ChargePoint, who has fallen out of favor for quite some time. But before we get to ChargePoint, it's worth noting that at the macro level, we just received inflation details with the CPI coming in line with an expected increase of 3.2%. We have the producer price index, or PPI, dropping on Thursday. The relevance here is that these are the last inflation data readings before the Fed decides whether or not it will once again hold rates steady or start cutting. With the CPI once again rising here, I fully expect that it is too early to cut. But either way, expect some volatility in the coming days and weeks. As far as ChargePoint is concerned, they held their earning call for Q4 and full fiscal year 2024, that's calendar year 2023, last week on March 5th. The stock is down over 90% from its peak, including the 8.50% drop this past week at the time of the recording. So with ChargePoint at $1.83, essentially hovering near all-time low, is this stock still a buy? That's the question I'll be answering. And so in today's video, I'll go over my main takeaways from the earning call, then take a look at the analyst ratings, some changes here, so you might want to stick around for that, and close with what I'm personally doing as far as buying, holding, or selling. As always, this is not to be taken as financial advice. I'm not a financial advisor. This is my personal approach to investing and the thought process behind it. I'd recommend watching all the way through so that you don't miss out on anything pertinent I'll be sharing. Drop this video an early like if you haven't already, and smash that subscribe button. Those are two easy ways to show your support to the channel and help it grow if you appreciate the content. All right, let's get into it. Let me start by saying that there is good news and there is bad news, making this truly a mixed result. Despite the fact that I'm bullish on the stock, there's enough here to be cautious near term. It always comes down to the time horizon lens one is looking through when investing. Looking at the earning results, revenue took a hit in Q4, coming in at $115.8 million, which is down 24% on a year-over-year basis. But on the flip side, if you look at the full year performance, revenue is actually up 8% to $506.5 million versus the $468.1 million the year prior. Margins in Q4 came in at 22%, which is down on a year-over-year basis compared to the 23% the year prior. But if you look on a quarter-over-quarter basis, we actually saw a strong recovery from negative 18%. When it comes to net loss, there's no way around this one here. They lost more money in Q4, both on a year-over-year basis, quarter-over-quarter basis, and overall for the full year. But if you recall, the increasing losses were one of the main drivers behind the decision to lay off about 12% of their workforce, which ultimately was going to save them $33 million in annual operating expenses. The forward guidance was less than stellar at face value. They guided to revenue in the range of $100 to $110 million in Q1, which actually represents a 19% decrease on a year-over-year basis. They did comment during the earning call that they fully expect to make up for the slow start in the second half of the year. And to further reinforce the idea that things should be improving ahead, they reiterated their commitment to achieve profitability by the end of this year. Should they deliver on this promise in a less restrictive environment driven by lower rates, we could see one of the most interesting turnarounds in stock performance. The last couple of things to note here, and certainly worth paying attention to: subscription revenue was up 30% to $33.5 million in Q4 2023 compared to Q4 the year prior. This is a substantial increase and a big driver for the full year-over-year revenue increase of 8% I mentioned earlier. And during the call, they stated the intent to double down on increasing subscription revenue. Last, but certainly not least, and what this always boils down to, is earning per share, or EPS. And when you look at that metric, ChargePoint actually beat expectations by delivering a loss of 12 cents versus the expected 13 cents. As I said, mixed results, but highlights around subscription revenue and guidance to reach profitability by year end are the reason analysts are still cautiously optimistic on the stock. And with that, let's take a look at the recommendations. The overall consensus rating is still a moderate buy, with 5 buy ratings, 5 hold ratings, and no sell ratings. Despite being down this low, no one is recommending a sell. I would pay attention here. This is key to take note of. Both the high end and low end of the range remain unchanged at $6 and $2 respectively. The average consensus price target is, however, slightly higher at $3.58 versus the $3.21 prior. Now, here's the kicker. Assuming we're only able to reach this average target, you're looking at an 86.46% increase from the current level and just over 3 times the returns when we hit the top end of the current range. This is not negligible at all, okay? Now, ChargePoint has been consolidating at this level for quite some time now and really tracking its 50-day moving average incredibly closely, as you can see here. So what does this mean to me? To me, it means that the stock is basically waiting for a catalyst to break out to the upside. Despite the mixed results, the seemingly poor near-term guidance, and cautiously optimistic full-year expectations, we did not see a massive drop post-earning. Again, looking at the technical chart, RSI has been fairly steady and is currently sitting at the 41.29 level, meaning that the stock is potentially in search of a catalyst to break to the upside. I actually use their product on a daily basis, and I can see the expansion that is taking place around my city, with ChargePoint steadily growing the public infrastructure. They now count 74% of the Fortune 50 companies and 60% of the Fortune 500 companies as customers. For reference, they had 54% of the Fortune 500 companies a year ago, so moving in the right direction in customer acquisition. The last time we spoke, I told you that so long as we stayed below my cost basis, I would continue to accumulate. I have now reached my minimum share count of 1,000. That's a 300 share increase, and I've dropped my average cost from $2.53 to now $2.43. I will more than likely continue to add within my means and further drop my average cost while we remain this low. Investing in ChargePoint isn't without risks, no doubt about that. That said, this is still one of the most sound investments, in my opinion, to bet on the EV transition if, like me, you believe in the electric future. The last thing I will say is this: it will be a bumpy road ahead, no doubt about that. But if ChargePoint can further tap into its subscription revenue, expand its margin, and execute on delivering the promised profitability by the end of this year, the price action will change favorably and quite quickly at that. Do not forget that many auto manufacturers, including Tesla and NIO, are targeting 2025 for new model introductions. Just recently, Stellantis launched the first ever Dodge Charger EV, set to go on sale this summer, and their Dare Forward 2030 strategic plan includes moving towards electrified and more efficient propulsion systems, cutting its global carbon footprint by 50% by 2030. There's no stopping the EV transition at this point, and ChargePoint is still the #1 EV provider for level 2 charging solutions both in the US and in Europe. And so the bottom line here for me is simply this: luck favors those who are prepared. And so to me, preparation really takes place while the stock is down, and most are reluctant to allocate because it's not what is at right now or will be next quarter, but rather 9 to 12 months out. But on that note, that is it for me today. If you found value in my content, click the like button and share with others who you think could also benefit from it. For my newcomers, subscribe. It's free. And don't forget to ring the notification bell so that you too can stay in the know. I'll be back on Sunday for my weekly video and potentially during the week for an extra one. Till then, you can keep up with me here on Twitter for crypto and NFT related news. Thank you for watching. Stay humble, hustle hard, and I'll see you in the next one.